Hello students, these video clips will cover the private equity valuation under DCF models with corresponding discount rates. We have three free cash flow, discounted cash flow model as discussed during the class. First, the capital cash flow CCF model using unlevered cost of equity. Second, free cash flow over firm FCFF model with the weighted average cost of capital as a discount rate. And then free cash flow of equity using the levered cost of equity. Again, the capital cash flow model considers the interest tax shield as if 100% equity financing, because the interest tax shield impact on influence on the positive effect to the equity investors. So we use this formula as discussed, right? But the free cash flow model, we assume that, just we're measuring the enterprise value, considering all the capital investors, debt investor or equity investors. So first we calculate the cash flow of the firm and subtract the total debt, we got the equity value. We assume the capital cash flow model where the debt repaid during the projection. That's why we use the unlevered cost of equity, which is not affected by the debt structure, capital structure. But FCFF model, where the debt maintained, we assume the debt maintained during the projections. So we use just the weighted average cost of capital. Finally, the free cash flow of equity. That means we directly calculate the equity value. And then the cash flow calculation started from net income. But we need to consider net changes of the debt repayment or the new debt, because that also will increase the cash flows of the equities. So here we have a lot of inputs, right? And then discount rate. First, we need to calculate the discount rate. We already discussed how to derive this, the beta, unlevered beta to beta, right? The unlevered beta, levered beta, unlevered beta, and then levered beta. Levered beta from the comparable firm, and then we purify this, the levered beta, because the levered beta of the comparables has way different capital structure. First, we have to remove the debt impact. So unlevered beta, how to get it, right? 1.9 here, unlevered beta of a comparable firms divided by 1 plus 1 minus, where's tax rate, which is given, right? Both on comparables and the firm. And then close the parentheses, and then multiples, debt structure, right? Debt to equity ratios, right? Which is the comparables. So we got this unlevered beta of the comparables, and then we use this unlevered beta to the levered beta of the firm using the unique debt equity, the structure of the company, right? So here 1.53 now times 1 plus, right? Open the parentheses, 1 minus tax rate, then multiply by, now this is target debt to equity ratio of the venture firm, right? And then we got 1.76, very high, 10% high. Again, why it is so important, cost of equity in terms of CAPFEM model, only the factor that changes the cost of equity is the beta. RF, RM minus RF, which is market risk premium, are identical in any other companies, right? So cost of equity here, how to calculate it, right? The 3%, which is treasury bill risk-free rate, plus market risk premium. If they are given a market rate, we have to calculate the market risk premium from the market rate minus treasury bill, but this is given. Now we apply this CAPM model, unlevered cost of unlevered beta unlevered beta. Where is it? Right, this one. And then we need to consider if we found some additional private equity risk premium, for example, the illiquidity, the risk premium or default risk premium, right? And then we put here. So 20.3%. 0.3% is the cost of unlevered, the cost of equity. Now, levered cost of equity is just simple. One more time, 3% plus 8% market risk premium multiplied by now levered beta of the firm, right? Then we add this additional private equity 22.1%. Finally, weighted average cost of capital that will be used in the FCFF model. So it's kind of tricky. If we are given the debt and equity separately, then we can just apply the proportion of the debt and the proportion of the equity in the weight, right? But this case is different, right? So in this case, first, how to calculate the cost of debt part, weighted average cost of debt part. First, 11% is debt rate given, right? And then this must be tax deductible, so 40%. And then we have to calculate the weight of the debt, as we discussed during the class. So total debt to equity ratio divided by 1 plus, one more time, 25%, or 0.25 debt to equity ratio. That explains debt over total debt plus total equity. And then we need to calculate the weight of cost of equity, right? So where is the cost of equity? Levered, because the cost of equity levered considered debt. When you calculate the weighted average cost of capital, we definitely know that the company has debt, right? So we use this 22.1% as a cost of equity. Now we need to calculate the weight of the equity out of total value, right? In this case, how do we calculate? As we discussed, 1 divided by, right, 1 plus 25, 0.25 debt to equity, one more time. So we got, finally, the 19%, which is weighted average cost of capital. Okay, so here, let's move to the calculating free cash flow. We have the EBIT, earnings before interest and tax, from the financial projection provided by the venture firms, the entrepreneurs, the founder. They will provide this financial statement, right, in the form of business plan or the performance every quarter and every yearly basis. Now we received these financial projections. Based on this financial the statement, we will develop the free cash flow. And then this free cash flow model will be used in 3 different types of discounted cash flow, in CCF model, FCFF model, and FCFE model. And then we will use this unlevered cost of equity, weighted average cost of model, and then a levered cost of equity that we calculate in here, the discount rate. Okay, let's calculate the interest expense. First, how much is the current debt or debt held constant? There you go, the 3 million, right? The 3 million now times how much is the debt rate? As indicated in the input section here, the 11%, right? But that amount must be fixed, right? With the $sign in each cell, because the interest expense is based on the debt held constant for the projected year, never change, right? So 0.33, $330,000 is the interest expenses. And then let's drag. Now let's calculate earnings before tax from EBIT minus the interest expense, right? Here, just the subtract. And then drag it to the right. We got the EBT, earnings before tax, for the projected years. Let's calculate the tax expense. So each EBT must be now applied to this 40%, right? I'm gonna fix this 40%. By doing so, when I drag it to the right through the 4 years, it doesn't change, right? So we have tax expenses in each year. Finally, EBT minus tax, we got this net income. Let's move it to the right. So we finally got this, all the net income throughout the projected years. This net income must be now adding this depreciation. Why? Because the depreciation is not actual cash out, but the net income, when you calculate this EBIT, is already considered with this depreciation expense, even though it's not the cash flow. That's why we need to add back the depreciation. Capital expenditures, we received a financial statement on the balance sheet that shows like fixed asset increase or decrease, long-term asset increase or decrease, the intangible asset, property, plant, equipment, all the capital expenditures between 2 balance sheet years. We have to get this increase, the changes in capital expenditures. If the company increases their sales, that is based on the increase in the fixed asset. That's how the company generates more sales, right? So if we got this balance sheet between 2 years, we calculate the changes in capital expenditures. So we found that this amount has been increased each year. Again, this is the changes between 2 balance sheet years. Changes in working capital. But these changes in capital expenditures, that means we purchase more asset. That means the cash out for the cash point of view, right? Cash direction. Changes in working capital. Working capital require the cash spending. For example, accounts receivable, intangible, like inventory. We increase this asset by spending cash, or accounts receivable increase, and then this sales increase on credit. There's no cash injection, but collections, but we increase the sales. That's why the increase in current asset is not actually increasing the cash, but decreasing cash, right? But the current liability, actually we borrow more money, right? Or we delay to pay the cash. So the company, inside the company, there is more cash. So the current asset minus current liability is the working capital. If the company increases this working capital between 2 years, that means cash out, because the current asset is greater than the current liability. So the changes in net operating working capital, if positive, that means negative in terms of cash, right? So we'll apply this calculated free cash flows to the capital cash flows. Second, the free cash flow of the firm. Third, the free cash flow of equity model with corresponding discount rates. Okay, see you in the next video clip. Bye-bye.